I'm Keith McCullough, and welcome back to the finale. We have our in-house crew now here. And I must admit, as many of you know, I'm a religious guy, so I have a new commandment. I shall not mention the tickers of anything we launch, right? I shall not, or our legal department will come after me. I still don't get those rules, guys. Welcome to what I'm going to call the quad box. See how I did that? It's nice to have teammates, line mates, really. This to me is like, sophomore year, Yale, all of a sudden these two new guys pop up onto the line, and I'm like, and they end up being two of the best players in Yale hockey history. I was like, this is better. So David Salem and I, of course, have been on the team for a little while together, but we're welcoming both who we call RPK, or Patrick Kent, and Sam Rahman. So I'd just like to start, well, first of all, thanking them, and thanking all of you for the support for the tickers that I shall not mention, but they run them. Believe me, they all run their own, or at least RPK. Will start with him first, who is about to launch his two, and I think a good starting point, RPK, would be just to give people a bit of your background. You worked for Steve Cohen, you worked at Wellington, you're portfolio manager, but you've also had to. You and I are. Yeah, you're a lot. I shouldn't say you're a couple years younger than me, but you're around the same age as me, right? And you've had to traverse this. How the discussion that I had with Jared Kubin yesterday, for example, you've had to traverse the man and the machine, the stock picker to the portfolio and factor picker. So maybe while you're doing your introduction, you can talk about that.
Yeah, I mean how it's evolved over time, right? It's changed a lot. The game's like I think. Sam touched on this in a piece he wrote, and I've been working on something similar that I'll probably touch on the same points, which is that, just think about the participants in the marketplace over the last, 20 years. Like I've been a investor, analyst, portfolio manager for basically 25 years. And, when I came into the business, we were like getting our research distributed by fax in the morning. Like there weren't even, I really sound. I hope I don't look as old as I sound. That's that we used to get like a stack of research like delivered from the sell side in the morning. It was like a light bulb moment when we started getting PDFs like email to us. Right, that was like a whole different game. So it's definitely like the pace, the velocity's changed, and the fact that I think a lot of investors don't necessarily adjust their thinking enough as it does change. They consider that these things will still remain true, heuristics will remain true that have been true, and don't take into account like how things are changing over time. And Sam touched on these points in his note, as I was saying, just the simple amount of money that's being, what you call the machine, like that's being, following momentum, that's being run by systematic portfolios or run by quantitative driven portfolios that are just passive flows and second derivatives of passive flows, and like all these things that are come together to push securities and to pricings to extremes sometimes. It's actually a great opportunity, I think, for active management in that kind of scenario. But maybe not the way you traditionally played the game, right? I think those tools have evolved over time. Coming back to you and I have known each other a long time. I met you probably when Hedgeye first started, and I think we clicked early on just that. I think we had both landed on a similar place about rate of change, and the rate of change on rate of change mattering more than almost anything else in the markets, and that's kind of informative to the way I think about investing, starting from, I started out on long only. I started out on long only value. I went to long only opportunistic. I went to then to long short when I worked in the hedge fund side, and then to Wellington where we did a little bit of long short, but also opportunistic. And then I ran a global impact fund for several years as well before Mellon, which I did opportunistic. So it's all that's informed sort of the thinking all the way along.
Mm-hmm. That's very helpful, and I think, Sam, that maybe you could follow up on that too, or follow on to that. Again, when you sat in the seat running the Johnson family's growth money, or now we're calling it your quality strategy, the machine wasn't anything remotely close to what it is today.
Yeah, it's just gotten more complex. I think that the hardest thing that people find in this business that's hard to do is that accept that you don't have the information. You don't know everything that you need to know to make a decision. And I think, I always smile when you kind of rip Captain Stockpicker and you're in your macro shoot, but because I smile because I put my hand up, so yeah, that's me. Because I think the journey for all of us, I think, on this interview is understanding that the humility that okay, there are certain things I am comfortable knowing and I have conviction on, and for me that's duration that is like 12 to 18 months and beyond, maybe even up to 3 years from a fundamental perspective. Anything short of that, I have learned over time to really respect the information that's embedded in, I mean, you call it the flows, the signal, the charts, whatever word people like to use. I mean, I think you have to appreciate that in this very, very complex pricing mechanism that prices new information every second, every day, that you don't know all the answers. And so when you sort of let yourself go a little bit and open your mind to the fact that, it's okay to not know, to come in every day and not know what's going to happen, but be completely comfortable with that.
Yeah.
And accept that the playbooks that we all grew up with, that we all learned, are not necessarily the playbooks that are going to work now and going forward. I mean, the classic one that I think you've talked about recently is like, well, staples are defensive, so maybe that's a great way to hedge the market, given how high it is and how expensive it is. The problem is staples from a fundamental perspective, and obviously, as you've pointed out, from a signal perspective, absolutely suck. and like when I bring in, I mean, you've talked about the signals importantly, but when you layer in the fundamentals, and you guys have talked about the K-shaped economy, I mean, 90+% of the staple stocks in the index are all exposed to the bottom part of the K. And there's maybe one stock, Estee Lauder, that probably isn't exposed to the bottom part of the K. Everybody else is. You're losing SNAP benefits. Cost of living has gone up. It's hard to get a job for new graduates. The middle classes, it's harder and harder to stay in the middle class. Where do you think they're getting their food and groceries and whatever? And you can throw restaurants in. If restaurants are quasi-staples, I mean, it's a tough space, and these guys have benefited from pricing post-COVID. If you look at the underlying volumes, they're all negative. Mm-hmm. So when that pricing goes, it's going to be ugly. So that the old playbook of staples are defensive, I don't think that's going to work for you now. So a lot of people run to that by a knee-jerk reaction. It's a dangerous thing. So you have to be open-minded about what are the new correlations, what are the new defensive, hedged areas to protect your portfolio, and it's not the same. It changes every time. Every cycle is different.
Yeah. Well, that's the beauty of the machine. That is the beauty of fractal nature, I would argue, is that you don't know what every single component, what human can tell you. If you live on the coast of Maine, which Salem lives close enough to, why that is so identifiably beautiful, but you have no idea on how that came to be or any of the parts, but you're good with that. You're good with that. You're okay with that. To me, what's happening with you guys, and it's great to be able to do it as a team because it's humanly impossible to do it, obviously, on your own. And when you attack it from different strategy perspectives, you get different perspectives on top of perspectives, right? So you get rates of change on top of rates of change in RPK's point. But to me, what's really happening there, Sam, is that the machine is figuring out the answer to the question faster. That's it. The future is always going to be different. But Wall Street, David, maybe a good way to jump in here before we start talking about performance and things of that nature, talk about nature, along the way, you have these massive, the machine, that's basically my code, my cheat code, right? It's to front run what the world is going to recognize as true, right? Everything Sam said is true about the underperformance of staples, restaurant stocks, et cetera, and therefore the outperformance of anything related to AI because they're growing and these guys are losing. In ETF space or macro, I don't see a lot of disconnects versus fundamentals. I see a lot of front running going on versus fundamentals. I mean, maybe you can speak to that.
Yeah, I can. But first, let's just stick with the analogy to the coast of Maine, right? Because from the 50,000 foot level, if you took a photograph today and compared it to one taken, say, 50 years ago or 25 years ago, you'd say, well, it hasn't changed at all. But when you get closer and closer to it, you realize it's been massive change, right? But microscopic change, but it all adds up to material change. And I think that's what's gone on over the course of my career. And as I like to say, I'm managing money today, very privileged to be in the seat that I'm in, and I'm very grateful for it, in a manner that's completely different from what I did earlier in my career. And that's because markets have evolved. I might actually even ask Eric if you want to go to, we're not going to show a bunch of slides, Keith, but I think it's helpful to have something on the screen. So for the last 2 to 3 years, we've built a process that's tried to embody and kind of automate in a systematized way the process that I give you enormous, in fact, complete credit for having devised originally. So that would be the process slide number 6, Eric, if you've got it, that shows what we call Hubble. And very simply, Keith, you're amply familiar with this, intimately so. We can call them signals or quads, or we can call it macro as we do on this slide, macro and market data. And the point I'm driving at in trying to answer your question directly, to finish the answer to it, is that the more my career has evolved, the more certainly that I've sort of tried to evolve as an investment professional along with members of my team over the last 10 years, but particularly the last 3 years, the more and more we've come to pay attention to what we call on this oversimplified slide, market data. You can call those signals, price, volume, volatility, rates of change. And the final point I'll make here, Keith, is that I can reflect back my own path, which I won't go into here, but as everybody that's participating from Hedgeye today knows well, and many of our viewers know as well, I cut my teeth working at GMO at sort of the dawn of quantitative investing, working with Jeremy Grantham. And those quantitative techniques were applied in the main to security selection. And what's happened in recent years, and I'd like to think that we as a team are at the vanguard of this, although I can't prove the negative, I don't know exactly where all the competitors are, is that we're adapting these techniques and applying them to asset allocation and portfolio construction in a much more rigorous and systematic manner than certainly was done earlier in my career. So yes, security selection, even way back in my GMO days, was starting to get systematized, quantified, automated, if you will. But that was not at all the case with asset allocation and what I would call portfolio construction. And that's where we're trying to break new ground, where the system you devised is so incredibly helpful in enabling us to do that in a really disciplined manner. So full stop, back to you.
Excellent. Love it. And I want to go again. I can't mention the tickers. This is a commandment. I can't mention the tickers, but I can talk about what they do. So let's just keep going that way and go back around the horn, but stay with you, David. And we can't talk about the tickers, can't talk about the performance, but I have a pretty good idea about the performance, and anybody who pulls up the ticker could see the performance. Let's just talk about this. Like, why, despite, let's just not say what the direction of the performance is, which is good. Why are you so stressed out?
Yeah, as you know, I am stressed out because we've talked about it. All right. So first of all, I'll ask, why did you put me in quad 4? Right. Go back to the quad area. Right? Like
Well, you didn't say where you started the count, though. Maybe
I'm down here in the corner.
He's in quad 1.
But
Well, he does, by the way, he does asset allocation. So his strategy, not shockingly, is asset allocation. So in quad 4 is when he's really going to do well, because a lot of people have no idea what to do there. But go ahead.
But hey, boss, that's why I'm stressed, right? Because I can't talk about tickers, I can't talk about products or offerings, but people can find it. And what we're doing is receiving a very favorable reception by all the relevant metrics. So people are coming to repose more and more trust and confidence in what we're doing. I think logically that would cause one's concern to rise, just because you're being entrusted with more and more. I mean, these are people's lives, it's their hard-earned capital, it's their pile, as you like to say, Keith. So that's part of it as well. But we all know, humbly, that markets have a tendency to take back that which they have previously given. and so that's why I'm kind of stressed. And I mean, I'm very accustomed to this, in the way that every time you laced up the skates and went on the ice with Yale blue on, you were accustomed to being under that pressure. And I've done it for many, many years. I wouldn't have sort of sank into money management. None of us would on this call if we didn't in some way enjoy that. But we need to also be honest that it's very stressful, and I welcome the stress, but it is indeed stressful. In fact, I would argue, I think you would all agree, if you're not stressed out about it, there's some sense in which you're really actually not qualified to sit in the seat that you're sitting in. I don't know if Sam and Patrick would agree.
Well,
with
there's
that.
healthy. I mean, there's a healthy stress to it. I mean, there's no irony, by the way, that the guy chilled out with the ham hat on is the one who's the least stressed because he hasn't launched his ETFs yet. He has no P&L.
It's all paper. I know.
Well, you do. I joked with you the other day. I'm like, he sends me. I think it was Friday. Actually, we can talk about a paper account, can't we?
Yeah. No, we can talk about the paper portfolio.
I mean, I'm asking. It's a religious experience. I'm asking the gods here. I mean, a compliance department. Please tell me no. Nobody, there's nobody who's going to tell me no. But what I did, a very practical example, right? The market gets its ass handed to it, and then it turns. It's really in that turn where you see the ballast of a portfolio. Like how well does it handle the storm, and where does it come out when the sun rises in the east? Which, thank God, it did. I knew the end of the world was a probability for some, but for the rest of us, it was a very, 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 very low probability. And RPK pings me. He's like, "Oh, I wish this paper account was an ETF today." And I'm like, "You just like trading paper accounts, don't you?" And it is a little bit. It's got to be a little bit liberating, right? You're whole for a quarter century. You're on the switch, dude.
Well, yeah, but that said, to David's point, right? Like, that there's no consistent outperformance all the time in every week to week, every day to day. So when it's doing well, that's where the anxiety builds, because you're there's going to be a give back. I mean, because at some point, you're just looking at the way that the risk is structured in the portfolio, and what you're geared to deliver, right? I mean, this is I know David and I have talked about this when we've gone out on runs, and he has to listen to me rant about it. Is over the years when people would pitch their stock selection strategies, right, or their long-only asset management strategies, they'd say oh, well, we can deliver 200, 300 basis points over, the cycle over this period. And then you'd look at the risk metrics of the portfolio and be like, well, in order for you to do that, you'd have to have an information ratio of like Bernie Madoff's, right? There's no way, you're just not geared to do it. If I look at how much risk you take, if you're taking 300 basis points of tracking risk and telling people you're going to deliver 200 basis points of alpha, you're not. I can tell you you're not. And if you do put up a couple of years of your numbers, that's all probably just factors, and you're going to give it back. Mm-hmm. So there is always this understanding of how much risk you do have in the portfolio, what you really deserve to get if you're doing well, right? And best in the business are good, are right, maybe, slightly more often than they're wrong, right? And then just risk managing the times when you're wrong. And that's so knowing that, this is kind of to David's point, your anxiety does build when you're trying to manage it, even when it's going well, because you're like, oh, well, it's not going to go like this forever. So I'm already anticipating, what's the thing that's going to come down and maybe cause some give back.
Yeah, there's no irony, by the way. You guys know this because we have a morning meeting that we're on together, and many of you listen in on. It's called The Call every day, and the portfolio managers are allowed to ask questions now. That's through compliance. One day, RPK ran the call, which was the best call that we've had. So we're looking forward to these guys running the morning meeting. And the morning, Sam, that you remember I was talking about Sora and its impact on how you could take, as a content company, you can really take that final leap. Maybe not final leap, but again, maybe put the sword of Damocles finally right across the middle of the skull of the mainstream media. This is going to be the best day ever. And then by lunchtime, I have Pump going at China, and the market's having its worst down day in 2 months, right? It was evidently not my best day ever. But on that day, right? On that day, you, again, I can't talk about how your performance was that day, but I've seen how the portfolios acted coming out of that. And there's a big difference between what people think is growth investing and how you're defining quality and or quality growth. Can you go through that? Because I think that one way to get around being put in a box is just to get out of the box, right? You don't have to be a growth manager. You don't have to be RPK rattled off I don't know, 8 different kind of strategies you could have running long only money. I mean, you get to be who you are. You get to do what you think gives you the best chance against the machine.
Yeah, I mean, if you look at how people define growth, I mean, it's in the old way of doing things, there's a pretty narrow view of it. Because I mean, there's growth, there's like high levels of growth that's stable. There's rate of change of growth when something's accelerating, and that's, you can say that's cyclical, but that is like an accelerating growth, on a rate of change basis. So in different types of markets and different types of setups, there's different ways you can toggle the switch in terms of what type of growth you have, cyclical versus secular. And right now we have given the quad setup that you've talked about, 3, 2, 1, going into the first half of next year, you have a situation where, I can't remember, you probably know in terms of when the last time we had this one, but you have a situation where you could have cyclical growth, secular growth, all working at the same time. And the challenge for any manager that I'm gonna have to deal with is like, how do you balance that in a portfolio? How do you, in a concentrated portfolio of 50 stocks, how do you balance that level? And that's kind of what, as you've seen, I'm sure you see my trades every week or every day, is like, particularly in those down days. I mean, and the way the VIX reacts to how some of these news flow hits the tape is, those are typically great opportunities to, fade the tape. And you've talked about this too. When the market panics in a direction that is purely a headline-driven panic, you get a chance to go back in and add incrementally to the names that you have a lot of confidence in long term. So some of the changes you've seen, we've talked about, have been precisely that, where you kind of slowly shift a little bit to sort of betting more on your best ideas and the ones that have the best signal strength, and then slowly sort of peel away from the names that are not holding up as well in tapes that you think that they should hold up as well.
Yeah.
And that comes back to the, I guess the title of our segment, to diversification, where diversification at any different point of any cycles is going to be different. Several cycles ago, it was staples. Now it could be healthcare. Healthcare is coming out of a major downturn for the last year and a half, 2 years, but is finally joining the market and starting to show some relative strength. And if you think about the nature of healthcare with regards to the other sectors that have done really well, like technology that we all know about, and industrials, I mean, those are very different factors that are driving those 2-3 sectors. So you can build a portfolio where you could have a diverse group of sectors that act differently to each other. And part of, with a concentrated strategy, you can win in 2 ways in terms of what you own and what you don't own. Mm-hmm. I think that second part is really important, because if you are good at not owning the stuff that's going to do poorly, that's sometimes almost as valuable as the stuff that you own. So I think that's kind of like like a multi-layered way to think about diversification.
That's why, by the way, first of all, the way that you think about it gives you your competitive edge, right? That is your process. That is your discipline. That is your belief. If it is not a quad 4 pending and it's episodic, non-trending volatility, you buy the damn dips. Again, you get more aggressive. If this is February and we got that a volatility signal that wasn't that, you wouldn't have done that, right? Correct. Like there's a big difference, and Sam and I are in constant communication. I think, David, he's got the toughest strategy, no offense, out of everyone so far, because of one very basic fact. I think RPK is going to have, especially, I can't confirm or deny, he's going to launch a long-short ETF. I didn't say that, right? It's between us. But
there may be some shorting involved. We'll see.
But the distinct difference between what RPK is going to launch and what Salem has is that it doesn't have a lot of competition. Sam has to compete with the S&P 500, which has all the competition. Right? So I mean that seriously. That's how I think about it. I don't think I've ever said it to. Actually, we've never had a meeting together like this, so welcome to our first meeting together. But I've told this to Bloom, David, that I think Sam's got the toughest strategy and might always be the toughest strategy to beat the bogey.
Yeah, you can trust but verify. I've said that to a number of people, including Sam in our very first meeting, and I've thoroughly enjoyed getting to know Sam. And we should pay do homage to John McNamara, who's CIO at Ham, who's not actually on the call just because it would get too crowded. We only have 4 quads, right?
Well, I've talked to him enough, man. I just like
So from down here in quad 4, I'll agree with you and say yes. What I've often said, Keith, is that trying to outperform the S&P 500 with your typical institutional clients and their time horizons and fears of missing out in particular is the toughest job in finance. So that's that's the seat that Sam is in. Now he has a distinguished track record of doing it very ably. If I can just take a minute, in my, back in the day when I, for almost 20 years, ran TIFF, we were managing a lot of money internally, but I'd say probably at least 50% of my working hours was spent one way or another in choosing outside managers. So I had a 4-part framework for that: essential, favorable, unfavorable, and disqualifying attributes. I use a framework like that for almost every aspect of my life, personal as well as professional. but one of the essential attributes for an active manager like Sam was, of course, a kind of distinct and coherent investment philosophy that gives the manager a sustainable edge. That's really difficult to do in an institutional context, outperforming the S&P 500. But crucially, final point, Keith, right below that in this framework, which I've actually shared on HedgeyeTV, and somebody can zap a note to capital allocation at HedgeyeAM, andrewmichael.com, and I'll send you the framework. But right below that distinct, coherent edge that's sustainable is a willingness to adapt that philosophy over time, right below it as an essential attribute. And I think Sam, to his credit, to the extent we've talked about it, has adapted over time. What he's doing today is quite discernibly different from what he did when he first went to work for Ned Johnson. Mm-hmm. And that's to his credit. And I would argue, without knowing for sure, I can't prove this negative either, that if he continued to apply the techniques that he used at the dawn of his career working with Ned in the Johnson family office, they wouldn't work today. They just wouldn't work.
Yeah, I mean, that's what, RPK's worked with the most things that would be disqualified by David Salem. Because they don't get to that box. They cannot evolve. They are the melting ice cube. We had this, maybe we can snag it from yesterday's real conversation with Kubin where we showed the 4 big tectonic plates of assets under management. But at the very top, unless Genron's real quick right now, everybody knows what it is. It's mutual funds. And it's a melting ice cube. So you watch, there it is, look at that. Look at the size of that sucker. And this is there's a question in this, RPK, which is, again, how do you think of, Kubin and I kept kind of coming towards the answer. Maybe we don't have the answer, but we could be at the early, at the early dawn, really, of an inversion of that, in terms of where the capital is going to flow. If you didn't believe that, you wouldn't be at Hedgeye. Let's just start with that.
Oh yeah, no, it's. Remember, I called you.
I remember. Actually, you know what? Sam called me.
That's true.
Salem called me.
That's good. Yeah, good. All true. You pick up we're sometimes in the asset management industry, and Sam and Dave can confirm or deny this. I think we are sometimes the worst at analyzing our own business, despite the fact that we spend a lot of time analyzing businesses. And so there are a lot of people who show up every day and continue to play the game that they have in front of them, not realizing kind of the board's already been flipped on them. They don't really, they just kind of show up, this is what I'm supposed to do. This is what I'm compensated to do. I come in and do this, and they don't step back and sort of think about the direction of trends in their own industry. And when I sort of started to think about this more, you realize that 13 trillion or 14 trillion, I think, whatever the current number is in active mutual funds, that's an outdated wrapper, and it's probably on a perpetual glide path down. And whereas it's not going to all go toward active ETFs, but a large part of it probably can move there and probably should move there. Just for the simple sake of transparency and costs and a whole host of other reasons. And so this is an area that, we're talking about. Active ETFs are at $1 trillion, just past $1 trillion by comparison. So even if only a third of it went there, you're talking about that's going to be an area that could could triple or more over the next few years. So I think that's what you can sort of see, like how this is going to shift and how this is going to evolve seems to be really very clear.
Well, to me, it's very clear. Like, so if you take somebody who's like take Balkunas, you know who Balkunas is at Bloomberg? He covers he covers ETFs. Like he would know everything that you could ask him. He knows everything about ETFs. But the main problem he's got with ETFs is that the shift from passive to active has gone to levered active, right? That's where all the pin action is for all the retail investors, et cetera. You know, at some point he's going to have to acknowledge, which not everybody on Wall Street's going to eventually want to do, but they will have to do because performance does matter and other people will be able to talk about it, is that you can have active risk-managed ETFs, right? Like it's the one thing. So if you go all the way back, and Salem could probably give us an entire encyclopedic kind of rundown on how this went down, or went up rather. How did that mutual fund, top of the food chain in terms of AUM come to be? I mean, Bogle cut fees, right? That was the idea. It wasn't to risk manage it. It wasn't to have a plan. It was just to have a lower fee, right? Now our plan is to put Hedgeye risk management on top of strategies that we create, and I think that, even Balkunas won't be able to not like that at some point, but. This is going to be, like, to me, we're not interested in launching something that is beta, right? That's not, and we're certainly not interested in launching something that is levered. In fact, you have some thoughts. You can get into it without giving away, what we're about to launch. But like, how do you think about the expertise that we have in short selling? All the battle scars you and I have had. Would you have gotten your face ripped off, or would we have in the last 3 days? I mean, 13% for the most rolling short basket of consensus, the consensus hedge fund positions. That's a lot. Like, that would be a very bad.
Yeah.
That'd be a very bad problem if that was if we're running a long short ETF and that was our short book.
Patrick, before you answer, can I just jump in? And I want to yield my time to you to encourage you to talk of this story about you've told me about how you got your knees skinned shorting. Anyhow, I yield as much time as you need.
No, right? I mean, I've said this. I think I've probably even tweeted this before. Keith's heard me say it before. If someone comes in and says they haven't had a colossal, if you're talking to someone who's acting, investing, and they haven't had colossal mistakes, they either are a liar or they're inexperienced, right? And either way, you wouldn't really want them managing your money.
Exactly.
So if you can't readily come up with a list of absolute terrible mistakes you've made, and that you hopefully learned from, then you probably haven't been doing this long enough, and probably shouldn't be playing with live ammunition. I think I go back to my hedge fund days. I mean, I was in that seat getting my face blown off in a short position, and I remember I was short this I basically got stopped out of the position with a huge P&L loss. It's a good thing they didn't can me right there. They were kind because I had made it up in some other places. So, but I was short a health insurance company that I thought was basically I don't want to say cooking the books, but they were very aggressively accounting on their risk pool. I knew that the timer was going to blow up at some point. This was going to happen. And this was before I was ever introduced to Hedgeye risk management signaling, right? This was like I was committing the cardinal sin in shorting, which is going big game hunting. This was a stock that was up on a rope. It was just going straight up, right? And I'm like, this thing's absurdly valued relative to the peers. I mean, you can fill in any number of these types of stories over the last few years, right? Tesla, trades at 100 times, and a car manufacturer trades at 8 times. This stock is absurd. Fine, but that's not what's going on there. So don't, you're just talking yourself into a bad situation. And so I rode this thing for an incredible P&L loss. And here's the punchline to the story. I finally get stopped out of the position. We even had some puts on it to try to maximize this, which then they let me leave the puts on because they were already there. Those expired, and then literally 2 weeks later, the FBI raided their offices, and the stock was down 50% or something. And I was and of course, all you get from, you're all familiar with the hedge fund world. It's well, you really didn't time that very well, did you? And I was well, as if I could have known when that was going to happen, right? So really what that was poor risk management, right? If you waited for the signal to break, you probably would have, then you could have pressed the short or even initiated the short at that point. Didn't have to be there the whole time while it was going against me. So I'd say shorting takes I describe it oftentimes as a shootout in a lifeboat. Like it gets so ugly so fast if you're in crowded shorts or you're in momentum shorts so there's no reason to go big game hunting. There are plenty of wheat zebras out there to take down.
Yeah, that is a very, very important point. And again, understanding that risk management isn't just having a consensus hedge or having any hedge. Don't forget that Balkunis's biggest argument, which I agree with, I don't know why he's not friendlier with me yet, but I'm working on it. See how I'm doing this? Is that there is no risk management. Well, why don't you ask the only firm that's called every single stock market crash since 2008? I think we'd be pretty good at that, and that's why we launched Hedgeye Asset Management. When I think about that, I also think RPK. I've used the analogy of mountain climbing at the highest level, right? Like, I mean, at the highest level of climbing. Like Ed Viesturs wrote that book where, again, you think about that last summit, like your last time to short something. Like, am I going to go max on this short? Like, that is the most dangerous position you can take, is to go to a full position. Now, if the signal says don't do it, don't get out of that tent, right? Yeah. That ascent into that short position to the top is optional.
I mean, that's why I'm a CMT. I got my technicals background. That started with basically that, right? Like coming from a risk management situation. I was like, I need a better way to understand where I need to spend my time on risk management, right? Like knowing when you have a thesis on a position and the technicals are moving away from that narrative that you've got in your mind, like, be humble and ask, like, where should clearly I'm wrong about something. So I need to go figure out what I'm wrong about here, because, all of fundamental analysis to me really falls into what you know, what you don't know, what you don't know, and what you think you know and is absolutely wrong. Like,
so good. So good.
I mean, you had an interview a couple months ago, and I'm forgetting. I think I even have the book. I bought it, but they talked about how everyone lives in their own hallucination. You remember this? Like we were talking, like you were on this interview where it's like, yeah, everybody lives in their own like hallucination of the information that they take in. Like, so kind of, you've been talking a lot about the last, couple weeks, like all the bear porn out there, right? If all you do is ingest bear porn, I'm pretty sure your idea of what's going on in the world is going to be absolutely incredibly negative. Like, you're just going to go around looking for negative things.
Yeah.
Like, more confirmation to your point, right? And meanwhile, it's like you got a lot of stocks moving up and to the right, and you're just like, well, this is just even crazier now, right? So, like, again, everybody lives, and including myself, and I'm not trying to say like I have some differentiated, like I also live in my own hallucination, but the question is, like, can you acknowledge that and then find the tools to risk manage that?
Yeah, that's why I use nature as the governing like difference, because if you want or need something to be true in your own mind, it can be. But if you decide, again, it's optional to scale the summit, but it's mandatory to get down. You have to obey the laws of nature. I mean, when you analyze the wind, the snow, et cetera, using that analogy, and that's what we're analyzing, David, when we're looking at factors and we're looking at signal to quad. We're not prophesizing about this. We're professionals that have been there many, many times, and we know what not to do, which is probably the best risk management strategy just to start.
Yeah, well, as Steve Diggle said, your great interview with him, we're not engaged in prophecy, we're engaged in probabilities, right?
Yes.
But let me snag 60 seconds. I'm going to ask Eric to show slide 5 in the little deck I put together, because it's just a fun story that builds on exactly what we've just been talking about, right? Because you were talking about the systematic approach to determining when there's opportunity or peril. I put this together, Keith, for a talk I gave to a group of business lawyers on Monday. And you can see what it is. It's just basically a 2-year epic. And you can see it's like pain, agony, anxiety, and then finally the payoff, relief. This is just a depiction of what happened to the VIX. We're all amply familiar. We lived through this, all of us. What happened to the VIX and then the S&P. What this is, the colored panel, is basically my emotions. I was running TIFF at the time. We had a massive put purchase program on. And the key point tying into what Diggle talked about is, and what we're now doing, which is quite different, is we got into it way too early. Yeah. So we burned through, as I've said to RPK, I'm unusual as an investment pro in that the best trade I ever did was also the worst trade I ever did, measured in dollars. right? So we lost hundreds of millions of dollars of put premia as we moved from left to right. The agony was when we were confronted with like a career defining moment. Do we double down or do we give up? We ended up doubling down and we got the relief and we got way more in profits than we had burned in premia, something that Stephen Diggle talked about. We could have done better. But if I were managing this program today, I would do it in a completely different manner. Why? Because the techniques that we use, and we looked at Hubble before, that's built in a lot of good work by you and some others at Hedgeye, is telling us, no, you don't need today to have a massive put purchase program in place. You may need it moving forward. The signals will tell us that.
Yeah.
But I didn't have access to the signals back in the day, which is why I had this agonizing experience. And I mean, I remember every minute of it. And it was incredibly painful. Yeah.
I mean, back in the day, like when calling the '08 crash, I'd say I have 80% more firepower today than I had back then to make the call.
Yeah.
Right? What did I have? I had the cyclical analysis right, the base effects which were embedded in it, the rate of change of the economy slowing. I had quad 4 right.
Yeah.
The signaling, let's not forget, I got fired for being early in 2007.
Yeah.
Hedgeye started because I got to put it on again. Like, okay.
Yeah.
So that's one thing. Risk management, though, like, again, to our friends at anywhere in the industry, it's not just, when to get out. I mean, it's how long do you stay in, right, Sam?
Exactly. That's the point I'm making.
That's this bear porn thing that RPK is talking about. You could get out all the time. It's kind of the craziest thing. If you watch like a MAGA Trump phone and you watch like the bear porn like Dem phone, you might as well just play a video game because those are two completely different characters, right?
Yep.
And how to stay in, Sam, versus that turn, like nobody's seen you have to traverse a quad 4. Nobody's seen you walk across that ice bridge. Like, can you talk, I know how we've talked about it, but can you explain, like, in as concise a way you can, like how you think about the moment in time? Quad 4 could happen at some point next year. In fact, it probably will. We have a quad 4 on the map, so that's what I mean by probability, not just, here I am. How do you think about that?
Yeah, so I mean, risk management on the long side, but when you're long only, I mean, the key area that it really matters is getting out of stocks that are breaking down or the fundamentals are starting to deteriorate. You're not really paying attention to it, but the stocks are clearly not working and going against you. I mean, a lot of managers are good at buying, but only like the really good managers are good at buying and getting out of stuff at the right time. So risk management on the long only side is really making sure you prevent underperforming stocks becoming real torpedoes in your portfolio. But specifically to your question about quad 4, I mean, the way I think about it is kind of decision tree of like, any generic portfolio. And if you say we're going to quad 4, I mean, you start from, in my mind, you look at the highest beta positions in your portfolio and you already have those on watch, because going into a quad 4, typically the high beta names are the ones that really break down quickly in a big way. You're raising cash to prevent sort of more losses. And then with the opportunity we will have with these active ETFs is you have now with inverse ETFs and hedge ETFs and anti-beta ETFs, you can put in ETF products in the portfolio that act as a offset, acts as a hedge to your long position. So if you are going to keep some long positions, you're going to ride out a quad 4 month or a quad 4 quarter, you have some hedge positions that offset that. But it's basically, your high beta positions are the most risky ones that you're going to be worried about. You're raising cash, you're looking at anti-beta ETFs to kind of provide you the sale that prevents you from getting sucked into quad 4. And and then option strategies to overlay tactically to sort of protect your portfolio in some way. But I mean, let's be honest, in a long only strategy, if the market's going down, you're going to go down. The key is, can you bottom at a higher level in the market? Because when you come out of it, you can compound at a higher level than the benchmark or the S&P 500. And that, like when you look over multiple years, and I think you put a chart on this not too long ago, where compounding off a higher base vis-a-vis your competition or the benchmark over like a 2-3 year period is where you're going to ultimately win, and you're going to grow your capital.
Yeah.
But I think, to finish up on kind of what we're doing, if you step back and take a 40,000 foot view, and if you present Hedgeye asset management to an asset allocator who's like struggling, what do I do? I got to put these assets together in it and find uncorrelated ways to put together a portfolio that can help me ride through different types of market, quad 4, quad 3, whatever it may be, so that 3 years from now, 5 years from now, and beyond, I can say that we grew your capital. So like what we've done so far, and what we're about to do with Patrick and some of the strategies that he's going to work on is, if you look at the inherent strategies themselves, they're all very, very different. They cater to a very different sort of need state. And so when you present this to an asset allocator, you have a unique set of strategies that work in different times, that are managed in a very unique way. But the underlying support and foundation is Hedgeye's risk management strategy of the quads, mapping and measuring what the market's going to be doing and the macro is going to be doing over the next 3 to 4 quarters.
Yeah.
And knowing that signals are going to help us dictate what we do individually in each of our strategies to make sure that we navigate the markets in the most optimal way.
Yeah, McNamara, who David mentioned, is not on. He runs the other ticker that I can't mention. But again, I can guarantee you almost, not with 100% certainty because I don't know them, but like that these ETF people out there that write about performance, if our hedged version of the market, which is another ticker, had the underperformance against the alternative versus, I can't say is the outperformance currently, you just look it up, but versus the JP Morgan hedged, which is going on a $30 billion product, everyone would write about it. Everybody wants, the biggest downside to all of you, I think I told you this, I mean, if I haven't, then now you get the full disclosure, but the biggest downside for you guys doing what you're doing with the Hedgeye jersey on is that people would love to see me die. They would love to see Hedgeye KM performance sucks. They would love it. In some cases, more than anything, right? That's a good thing, right? That should wake you up feeling like alive, and the good kind of stress, David, right? That's a good thing. But I can't wait to see real asset allocators take a good look at all that, Sam, and say, wow, what are these guys? These guys have put a lot of thought into this. Yeah, I've only been thinking about it collectively for it's more than 100 years.
Yeah, although I always question that metric because they're overlapping years, right? Like none of us live through. You get the point.
So you're saying we all have the same heuristics? Is that what
Yeah,
you're saying?
exactly.
But they were David, in different, like the hedged S&P product that we created is not something you ever had, right? Like your asset allocation strategy is something I never had. I never ran long only money for Ned Johnson. Like it's a big deal for us to come together.
Yeah, no, it is. You alluded to the JP hedged product, so I'll simply say for like the 1,000th time in my career, right, that like superior or even pleasing risk-adjusted returns are not a necessary condition for success in asset management. As much as we might bemoan that,
that's true.
Right?
That is true.
It's a sad truth.
They can be a sufficient condition because people will chase success, but they're not a necessary one if you have enough marketing muscle
Yeah, pay to
And
play,
that's
baby.
just sad because it leads to a misallocation of capital. And I think really, Keith, when you boil it down to its utter essence, like why are the four of us and John and others involved, Michael and so forth, we have a team. Why have we come together? Because we want to promote the efficient allocation of capital. Like that's not an insincere statement, right? It's a good and noble thing to try to get that done. And but it's hard. It's really hard because you got people with massive marketing muscle that can sell products that people basically don't need or shouldn't be using. Anyhow,
Yeah,
I'll stop right there and get off my high horse.
No, but it's very consistent. I mean, it's fourth turning written all over it, right? RPK,
Yeah.
and we can get into, how you think. I'm sure people are going to ask you about biophysical economics, but that's a thing. That's a thing that he believes that he can teach me about. When you're in this environment, you're put into that mainstream media until you take yourself out of it, right, David? You're put into these financial products until you take yourself out of it. You need to take yourself out of the establishment and get yourself, into watching, instead of MSM, you might watch Joe Rogan. Instead of watching, commercials, you might, get a direct account on ESPN and just watch the damn thing that way. It's everything is changing. So, and the timing for me, is a blessing, because I could have launched asset management every year since I stopped being an asset manager, which is 18 years ago. And now we're at this specific point in time, RPK, where these big behaviorals in the cycle, the long cycle, demographic cycle, are they're just coming home to roost, and everybody knows it.
Yeah, no, I mean I think one of the titles of this discussion was supposed to be, or is going to be around like the 60-40 portfolio, right? And I had just tweeted something actually before we came on, partly to promote this, just saying that simple heuristics that are just fire and forget, like this is always works, are just, we're inelegantly dumb, right? Like by definition, you've done some like look back where you tested it over a defined period and said, hey, this works. Therefore, like it should work in perpetuity, right? And that's just not the case, because the market's a complex adaptive system like everything in nature. And so things change. And there's like, I think, I know George Soros called it reflexivity in his book, but, Heisenberg called it the uncertainty principle in physics. Like once you've observed something, by definition, you've altered it, right? And that's what we ran into the housing crisis, right? Like when we look at the housing crisis came about, I mean, you guys were talking about this, I think, in some of the panels, like, it wasn't just a mass delusion. It was honestly like people really convinced themselves of the narrative that like, well, look, there's never been a nationwide housing decline. It's only in pockets. So if you put these all together, then, you really look at it, housing values only go up over time. Therefore, we should lever it. Well, if you lever it, then you're going to cause even more price increase, which is going to only reinforce this narrative, which causes even more leverage until finally you broke the thing. Right? And that's kind of what we do, right? And so I think that's just sort of like once you've sort of observed a phenomenon and then start acting accordingly, it changes the phenomenon in the first place. And so I even look at like 60-40, you could see, like I sent this out on my Twitter feed, just like you look at around 2021, 2022, 2023, you see the volatility of a 60-40 went up and the returns came down relative to history, right? So like, just alone, like these things, that's a time period that we analyzed basically post the efficient market theory, right? And the optimal market with portfolio optimization, that was like, we brought these in sort of the 70s into the 80s. Well, it coincided with a period when interest rates peaked and then declined for basically 40 years. And so it's not a surprise that bonds and equities together look really good when interest rates have been declining for 40 years. Mm-hmm. That mix changes. Once like that, if that pattern changes and interest rates are no longer just going lower and lower, then maybe that simple formula doesn't work anymore. These are
the questions that, not just the asset allocators, and we're running out of time here, David, but I think maybe you're the authority on this, actually, if we were to have one. I think the industry would say that too, by the way. Like, who's going to figure it out first? Like, we live in America. Who's going to figure it out? The people or the pension funds? Who's going to figure out the better way first?
Yeah. Well, the only honest answer is I don't know, but it's the right question to ask. If I had to bet, I'd of course bet against the institutions because of this sclerotic character of their decision making and information gathering. But I honestly don't know. I will just observe real quickly because I know you got to take us out. But there's an enormous amount of ferment and I would say stress. I do have the great privilege of interacting with a lot of CIOs of major institutional funds all around the world, including but not limited to the U.S. And everything is up for grabs right now. I mean, these are ongoing, live, active, intense discussions about, the model seems to be broken. And this is particularly the so-called alts model, which is supremely ironic, Keith, as the industry as a whole is pushing more and more alternative products on what they call retail investors, right? So it's going to be really interesting to come back 5 or 10 years from now. I have some views that go way beyond the scope of today's discussion. Maybe I'll present them on a macro show or do a special episode. But these are the questions that people are asking, and you're right to put that question in front of everybody in closing here.
Yeah, the bigger money though, like Morgan Stanley. I'm guessing, it's an educated guess, Morgan Stanley or who else was at RPK that came out and said, oh, we're going to change 60-40, we're going to buy some gold.
Gold.
Bank of America.
Yeah.
I think you were giving them a golf clap, right? It's like, it's like I can almost guarantee you that came as a push demand from the clients.
Yeah.
The richest people in the world aren't sitting there watching gold go parabolic and say, not what the fuck. Like, I mean, if they're not long it. Go to a golf club in Westchester County and you ask anybody if they have a zero asset allocation to gold, precious metals, or anything, and they're going to just start asking if you're serious or if you're on drugs. I mean, but the rest of the people, the poor people who wouldn't know otherwise, they're like, oh, I just keep flowing into my 401k. I didn't know I could get gold. And so we're in that moment in time too, where maybe a contraindicator, but maybe not. Maybe this is the time where the people are now, like, they have the money. They're going to the man and saying to the establishment, you can't do 60-40. What are you, a certified idiot?
Mm-hmm. Yep. I think you're right about that. Time will tell. Again, I'm not certain, but I think you're onto something.
Yeah, well, we'll have to see. We're not launching a triple levered gold ETF. Okay, I can tell you what we're not going to do. We're not going to compete in the triple leverage space. But I am, as everyone who's watched this, it's actually the. I'm very fortunate and blessed, and I think that everyone who's watched Hedgeye for long enough will come to the same conclusion, which is, wow, this team is a lot better the more I get to know who this guy gets to work with, and that's why he knows what he knows, right? And that's a super humbling thing, like to be able to work with people and have people on your team like Neil Howe. I can't confirm or deny he's going to be part of an ETF, right? If I say something like that, I hope you know what I mean. But the fact of the matter is that you cannot have this kind of depth and breadth and experience and be not nervous. Like, if you're watching Hedgeye the Ham come at you fully loaded with RPK's hat, which is a nice one, those aren't for sale yet. Yeah, if you're sitting there looking around and here comes Hedgeye, I don't think that's the competition you put up on the chalkboard as what you wanted to come after you with. So thanks to my teammates for being a part of my Trojan horse here, our Trojan horse. I think we have a lot to accomplish, and I think the drive and the capitalism behind it is pretty powerful. So, thanks, guys. Appreciate it.
Yeah, thanks,
you.
Keith.
Appreciate
Great.
it.
Thanks, Keith.
Great.
Plus, they're all like awesome guys. Like, look at these guys. Think about it. For how many years have you owned a mutual fund, or you have your pensioner like my dad and my mom, and you ever known who actually runs the money? Like, that's kind of a basic question, right? If you were to know them, what do they do? Like, I think that very basic relationship difference, which is, we're here every day. I've been here for 3 days doing this investing summit, and I've loved it. Some people say, how do you do it? How do you get up and do the macro show and the call? It's because I love it. This is what I love to do. This isn't work. I love it. And if you can't tell, I can't help you much beyond that. But again, like this, you can look at. You can look into it every single day. You can dial into our morning meeting. You can watch the macro show. You can watch every single position change that any of our ETFs make because they have to post their positions at the close. You can see what all these guys do, right? And we're going to help you get to know them as best you can because the relationship should be that way. You've worked too damn hard for your hard-earned capital to give it to the man and not know who's in charge, right? Thanks for joining us. Appreciate all of your attention throughout the Investing Summit. There is much to do.